I want to thank you all for joining us today. Happy Veterans Day. And again, thank you to all of our veterans for what you have done for our country. We do appreciate everything you have sacrificed for us. So my name is Tom Brinker, and I've had the great fortune of working, albeit part-time, with the college for the better part of 20 plus years. In the special needs planning space, about 2 years at this time, and working with the Center for Special Needs Planning. I want to shout out to Kelly Piasante today, a dear friend. I'm glad she is with us, as well as everyone else. Now, today's topics are truly unique. I'm trying to help us increase our basic income tax awareness, and we're going to define today who is a dependent. And we're going to take a look at where we are today and where we may be going in a few short months. We'll also take a look at the Kiddie Tax and how that impacts our families. So today's discussion does benefit the general population, we as tax financial advisors, but we're also going to focus on parents caring for those with special needs. So if today's session will start out by giving a basic framework of our income tax law, reviewing some of the more current statistics, and then looking at our two main topics. If we look at our tax formula, and this applies in 2020, so nothing is really changing right now. As of 2018, and this is part and parcel due to the Tax Cuts and Jobs Act of late 2017, we look at income in the broadest of senses, meaning economic income. Now, economic income doesn't necessarily mean taxable income. So we look at income broadly conceived, and we subtract from that what they call exclusions. An exclusion represents an item of income that is simply not subjected to income tax. For example, a gift, an inheritance, the death benefit on a life insurance policy, tax-free interest on a municipal bond. That yields the starting point in preparing our tax return, gross income. Now, from gross income, we have those deductions that reduce gross income and arriving at adjusted gross income. AGI is a pivotal point in your tax return. When you look at AGI, especially when you look at 2017 and perhaps 2021, AGI is the gatekeeper. AGI will limit your individual itemized deductions. AGI historically has limited overall itemized deductions, overall exemptions. AGI quickly eradicates, phases out your credits. So AGI is a critical line item on your Form 1040. From your AGI, you subtract the greater of your Schedule A itemized deductions or your standard deduction. And a lot of you now know that the hallmark of the Tax Cuts and Jobs Act of 2017 was a significant increase in the standard deduction. For example, in 2020, for a married couple filing jointly, it's $24,800. Singles, head of households, right? Less. But single, married filing separately, about half, exactly half, in fact, of that $24,800. Remember, for 2020, even if you do not itemize, if you've made cash contributions to charities and you've spent at least $300 in your charitable giving, your standard deduction is $25,100. Pretty significant for a married couple filing jointly. So you were to subtract the greater of your itemized deductions, Schedule A, or your standard deduction. Now, with the passage of the Tax Cuts and Jobs Act of 2017, only about 1 out of 6 Americans even itemize their deductions anymore. We are currently not allowed a deduction for exemptions, be it personal or dependent, but we still need to know the definition of a dependent. This yields taxable income. We compute our taxes. From that, subtract any credits. A credit is a dollar for dollar reduction of tax. A credit may be federal withholding. It may be estimated tax payments. It may be that child tax credit or that other dependent credit. It may be the child and dependent care credit. But a credit is a dollar for dollar reduction of tax. The bottom line, either we owe additional taxes or the feds owe us. And looking again at our foundation, and I want you to look at these rates. In 2018 through 20, the lowest rate is 10, but the highest rate is 37%. Remember, before the Tax Cuts and Jobs Act, the highest rate was 39.6%, which we may end up reverting back to with a new president. Long-term capital gains and qualifying dividends. Very interesting setup here. We have had 3 different rates for qualifying dividends and long-term capital gains for about a decade. We have a 0% rate if you're in the lowest tax brackets, a 15% rate, the most common, and a 20% rate. See, the reality is that 20% rate on long-term capital gains and qualifying dividend income actually kicks in at about 35%, at the 35% tax bracket. Under prior law, back in 2017, the 20% rate really didn't apply until you were in the top tax bracket of 39.6. Okay, 39.6. And I do see a question. I have no problem sharing the slides, okay? You're going to find some of these slides riveting. Now, here's the intriguing part, and this may not be that hard to fall back on. See, when you look at qualifying dividend income, when you look at long-term capital gains, we all know they enjoy a preferential tax rate. But the rates, the breakpoint rates, are at pre-Tax Cuts and Jobs Act of 2017. That's why you're going to hit that 20% long-term capital gain qualifying dividend income rate at about $125,000 less than when the 37% tax bracket kicks in for those who are married filing jointly. Now look at these numbers carefully. Putting politics aside, think about what may happen next year. If we repeal the Tax Cuts and Jobs Act of 2017, well, for those folks who are married filing jointly, they may be looking at 39.6 if their taxable income exceeds $400,000 and not $622,050, or a projected taxable income for 2021 of close to $630,000. Remember too, there's a 3.8% Medicare surtax. And that Medicare surtax is based on what? It's based on your AGI, in essence, exceeding $250,000 if you're married filing jointly, $125,000 if you're married filing separately, $200,000 if you're single or head of household. And it applies to the lesser of your investment income or the excess of your AGI over those threshold amounts, which are not indexed for inflation. But I want us to look at our reality. I know this scares a lot of people. When you are raising a child with a disability, and boy, do I wish this was an anomaly, but it's not. We need to capitalize on all of these different income tax benefits. These are unrelated Internal Revenue Code sections. And we all know this to be true. As the number of children diagnosed with autism, Asperger's syndrome, and other neurological disorders continues to skyrocket, the disruption of the lives of all those concerned is unmistakable, as are the cost of providing care for this special needs child. I'll throw out a hypothetical. Good friend of mine is raising 2 boys, both having an autism spectrum disorder. their special school is currently closed due to the pandemic. They are out of pocket an astronomical amount of money for caregiver services right now. So mom and dad can both work. We keep seeing that autism diagnosis rates are rapidly rising. In March of 2020, the CDC reported that about 1 in 54 children currently have an autism spectrum disorder, or ASD. And here's the really scary part. Previously, it was 1 in 59 2 years earlier. 2 years before that, 1 in 68. The same for 2 years before that, so it appeared to be stabilizing. 1 in 88 back in March of 2012. 1 in 110, April of 2010, 1 out of 150, 14 years ago. 30 years ago, 1 out of 10,000. Potential tax benefits. Now, we have a lot of tax benefits out there, right? Potential tax benefits. These include deductions or credits for dependents, right? Medical expenses, special schooling, impairment-related work expenses, adopting a child with special needs, child and dependent care. So we have a litany of items that a lot of us overlook. Some interesting stats, right? Is the prevalence of autism increasing or just our recognition of it? Autism is now 1 in 54, according to the CDC on March 27th of 2020. Interestingly, boys are 4.3 times more likely to be diagnosed than girls with an ASD. And this survey is based on 8-year-olds. The study's conclusion is that the increase can be accounted for by increased diagnoses or misdiagnosis of children with a previously unrecognized autism spectrum disorder. Look, as a parent of a child with a disability, I don't care what the statistics are. I want to know, what can we do to help these children, these young adults, these adults? We clearly need to develop large-scale services for our children. This is a lifelong disability. I pulled some of these statistics just to share with you that this is not a national number. It's very localized. Autism spectrum disorder numbers are rising among other developmental and intellectual disorders. Although 1 in 54 8-year-old children have been diagnosed with an ASD, the incidence rate varies by state. In New Jersey, horrifically, 1 in 32, whereas in Colorado, 1 in 76. This is what really caught my attention. About 1 in 6, 17% of all children aged 3 to 17 have been diagnosed with a developmental disability, such as autism, ADHD, blindness, cerebral palsy, with almost 1 in 5 nationwide having some form of disability. I was looking at the 1 in 6, and I saw a great comment yesterday, maybe not so great. They said that would equate to the population in the country of California, that 1 in 6. It's a crazy number. According to a recent study by Drexel University, 1.1 million Americans with an ASD will turn 18 in the next decade. How are we as a society going to work with these people, help these families? And that was just published last month. So let's take a look at the exemption. Maybe not as exciting, but there's a great interplay here with SSI. Historically may be proactive for next year, you have historically been allowed to claim an exemption for yourself, and your spouse is allowed to claim an exemption for him or herself. Dependency exemptions. Now, I want us to carefully look at these definitions. We have traditionally had 5 tests. We have the support test, which you often hear about. You need to provide more than 50% of the individual support if you're going to claim him or her as your dependent. So more than 50% of their support must be furnished by the taxpayer. Support represents those basic necessities of life, including education and activities. Now, there are special cases. Multiple support rules. Multiple support rules mean no one individual provides more than 50% of another qualifying individual's support. But the other parties all provide at least 10%. And that would happen typically when you have several siblings taking care of an aging parent. No one sibling provides more than 50% of mom's support, but maybe with 3 siblings, they each provide 33 1/3%. What they're saying here is you can rotate mom amongst yourselves as a dependent. So Mo claims mom in year 1, Larry year 2, Curly year 3. Now, if someone provides more than 50% of mom's support, they by default would claim mom. Children of divorced parents, a custodial parent can waive the dependency exemption to a non-custodial parent. But this is where it gets tricky. We decided 15 years ago we were going to clean up the definition of a dependent. So we created qualifying child and qualifying relative. Qualifying child and qualifying relative test. The qualifying child test is easier to meet. I want you to bear with me here, because I spent a lot of time trying to dissect this for our families. A qualifying child test will focus on the age of the individual, the residency of that individual, and their relationship. So if your son or daughter is 3 years of age, living at home with their parents, well, that's a no-brainer. But the qualifying child test looks at age, residency, and relationship. And I want us to think about residency, often forgotten. Who is a qualifying child by virtue of age? A qualifying child is a person under the age of 19 or a full-time student under the age of 24 with no age limit for individuals who are totally and permanently disabled. Your 28-year-old son lives at home with you. He or she is totally and permanently disabled. They have Asperger's syndrome. They're a qualifying child. The relationship test. It requires that the child be your son or daughter, stepson or stepdaughter, brother or sister, stepbrother or stepsister, or descendant of the taxpayer. Adopted individuals qualify, as well as anyone placed in the taxpayer's home as a result of a legal proceeding. This is the kicker. The child must live with the taxpayer more than half the year. The child must live with the taxpayer more than half the year. So your 28-year-old son or daughter who is totally and permanently disabled and lives at home, not going to be an issue. But the million-dollar question is, what if they live in a group home? What if they live in a home outside of your home? And we'll talk about that in a second. Also, even for an unrelated individual, if they're a member of your household for the entire year, even if they're a foster child, unrelated individual, they can still qualify as your dependent. Here's the question I have heard. What if the qualifying child or qualifying relative is receiving SSI, Supplemental Security Income? The receipt of SSI may result in forfeiting the dependency exemption for a child that is totally and permanently disabled. However, the loss of the dependency exemption may depend on qualifying child or qualifying relative status. Remember, the qualifying child is living at home with you for more than half of the year. qualifying relative is not. Children qualifying for SSI can receive a maximum federal benefit of $783 a month, $794 next year, with most states adding a stipend. Now, what is the key here? Well, the key here is going to be, ready? Reviewing the support test under each status. But I share with you, that's not the only key. It's residency. Residency. To comply with the support requirement, the dependent child must not have provided more than half of his or her own support. Needs-based support, such as SSI, is not included as income, nor counted as support provided by a QC for this test. SSI, and we all know supplemental security income, is for support, correct? It's not deemed to be support if you're a qualifying child. However, SSI is counted as support under the qualifying relative test. Okay, that's a big difference. Now, I want us to think about this. You've got to provide more than 50% of another individual's support in order to claim him or her as your dependent. SSI is not support for a qualifying child, but it is for a qualifying relative. So that means as a parent, you've got to provide more than $9,396 in support, substantiated support for a qualifying relative. Remember, key takeaway, qualifying child status requires a residency requirement, which is not required under the QR test. The qualifying child must live in the same household as the taxpayer for more than half the tax year. As a result, if your child with special needs sole source of income is SSI, your dependency exemption will not be jeopardized under the qualifying child test, but requires further examination under the QR test as to whether or not an individual has provided more than half of the QR support. Okay. So now, if that child is living with you for more than half of the year, if they're your qualifying child, SSI is irrelevant. But if they're a qualifying relative, and here's the other test that will come back to bite you. If you're a qualifying relative, meaning you are not living at home more than 6 months of the year, you will also need to meet the gross income test. The gross income test means the party that is not living with you has gross income below the exemption amount. The exemption amount, had it been deductible for 2020, would have been $4,300. For a qualifying relative, regardless of whether or not they are totally and or permanently disabled, in order to claim them as your dependent, since they are not living at home for more than half of the year, you need to provide support that exceeds $9,396. That's the $783 times 12. And it's going to be higher than that when you factor in the state stipend. And the individual for whom you're trying to claim as your dependent must have gross income below $4,300. So if they have a part-time job and they're making $4,300 or more in 2020 or 2021, and they live in an apartment, they're not your dependent. Joint return test. You rarely see this. The party for whom you can claim as your dependent must not be one who is married filing jointly unless the sole reason they file a tax return is to obtain a refund. Citizenship, residency test. Generally speaking, the party for whom you claim as your dependent must be a U.S. citizen, U.S. national, U.S. resident, or one of Canada or Mexico. Now, another nuance often overlooked. Effective for 2009, the individual claiming the exemption must be older than the qualifying dependent. Well, there's a tweak to that rule too. Now we'll go through these changes quickly, but I want to share with you an IRS notice and a proposed regulation. See, we all heard that the dependency exemption amount had been zeroed out effective 2018. It may have been zeroed out in theory, but not for these other tests, not for the qualifying relative test, not for the head of household test, not for the other $500 dependent credit test. So the IRS had planned back on August 28th of 2018 to issue a series of regulations, which they did on June 8th of 2020. They are providing that the reduction in the personal exemption amount to zero for tax years 2018 through 25 will not be taken into account in determining whether a person is a qualifying relative. Can you imagine if it really was zero? That means if that qualifying relative had $1 of income, they would not be your dependent. In defining a qualifying relative for purposes of various provisions of the code that refer to the definition of a dependent in section 152, including for purposes of the $500 credit for other dependents under section 24 and head of household filing status under section 2, the exemption amount will be treated as if it's still existing. And it will be $4,300 in 2021 as well. Now, the IRS goes through the legislative history as to why they're allowing this. It was never the intent of the law to disqualify head of household status or qualifying relative status. So here's where we are. The IRS issued a proposed regulation on June 8th, 2020, providing that for purposes of defining who is a qualifying relative under the code, the exemption amount is $4,200 for 2019, $4,300 for 2020, and it will remain at $4,300 in 2021, barring another change. Taxpayers have been permitted to rely on this notice since 2018. Another nuance. Prior to 2009, a taxpayer could claim a dependency exemption for an older sibling. This option is not available for tax years beginning in 2009 and later, unless the older sibling is permanently and totally disabled. Tiebreakers. They just don't make it easy. Tiebreakers determine who claims the exemption. First, if only one of the taxpayers eligible to claim an individual is a parent of that individual, the parent is entitled to the exemption. Second, if a child's parents do not file a joint return and each of them is eligible to claim the child as a dependent, the parent with whom the child resided for the majority of the year gets the exemption. If the shared time is equal, then the parent with the higher AGI for the year is entitled to the exemption. Now, at first glance, that seems very, very fair. The party with the higher AGI can claim the exemption. Remember, historically, the higher your AGI, the less likely you can claim individual itemized deductions, overall itemized deductions, and exemptions. And that was as recently as 2017. Third, if the child or other individual is not claimed as a dependent by either parent and other taxpayers qualify to claim the child as a dependent, then the taxpayer with the highest AGI for the year can claim the exemption. Now, if no one is really eligible to claim someone as their dependent, well, the party that does qualify can make that election. But here's the kicker. Effective 2009, the individual claiming the exemption must have an AGI higher than any parent eligible to claim the exemption. Okay, why do we have this rule? 10 years ago, 3 years ago, what has traditionally happened is, and you go back to 2008, if mom and dad had $400,000 or $500,000 of adjusted gross income, they had already been phased out of claiming any personal or dependency exemptions. So if they were receiving no benefit to claiming someone as their dependent, they were allowing their children to claim each other. Why? So the children could capitalize on the educational credits, child tax credit, benefits they as parents were no longer entitled to. So prior to 2009, parents with high AGIs subject to phase out of exemptions and reduction or complete loss of child tax credits, they would forego claiming the exemptions and allow a child to claim the exemptions and child tax credits for other siblings. This option is no longer available unless the child claiming the exemption and or credits has an AGI higher than their parents, which would defeat the purpose. Now, an odd proposed regulation. The definition of support now includes paid health care insurance premiums, but not life insurance premiums. The proposed regulations also provide that where the highest AGI of two parents must be determined due to equal custody, all income on a joint return of one or both of the parents is to be counted, but not just their income, but their step-parents as well. Interesting change. Now, I'm sharing with you this slide for the simple reason that if we repeal the Tax Cuts and Jobs Act, the phasing out of personal and dependency exemptions will be restored. And remember that phase out under Section 151? Every single year you had adjusted AGI thresholds. And to the extent your AGI exceeded these thresholds, you would lose 2% of the available exemptions for each $2,500 or fraction thereof by which your AGI exceeds these amounts. The incremental adjustment was only $1,250 if you were married filing separately. Just to give you an idea, this may be back. Married taxpayer has two exemptions. The exemption amount was $4,050 back in 2017, $8,100. AGI is $343,800. Threshold back in 2017, $313,800. So you're $30,000 above the threshold. Divide that by 2,500 equals 12 times 2%, 24. So you're losing 24% of your exemptions across the board, meaning you're allowed 76% of your otherwise allowable full exemption amount. In this case, that would be what? $6,156. So just be aware it may come back. Now, take a moment to look at your Q&A. ZQ, what you want to look at is, are they collecting SSI, SSDI? Okay, I want to try to address some of these questions at the end. Good questions. Paul, highly unlikely. If your child is living away at school, they are not living with you for more than half the year. Okay? You've got to document that you are providing more than 50% of their support and that they have gross income below that $4,300. No, SSI will not be reduced. Will not be reduced if you claim your child as a dependent. And quite a few of us have personal experience with this, so SSI will not be reduced if you claim your child as a dependent. Unfortunately, and I'll share this with you, and it's almost something you'd want to laugh at, that $1,200 stimulus payment your dependent child who is collecting SSI would not be entitled to that. If your child is not your dependent and is permanently and totally disabled, they would be entitled to that. However, more than 50% of the people I work with adults with disabilities claiming their child as their dependent receive the payment, despite what the law says. I want us to take a few minutes and look at this kiddie tax and how it impacts all of us. And we've been all over the place regarding this. The Tax Cuts and Jobs Act did initiate some changes, but you've all heard they have reversed all the changes with the Secure Act. So let's take a look at these changes, where we were, where we are, where we're going. You can safely have your dependent child have unearned income up to $2,200 as of 2019 without the imposition of the kiddie tax. Pre-Tax Cuts and Jobs Act, to the extent the net unearned income exceeded $2,200, remember there was a parental tax based on the parent's highest marginal tax rate. The Tax Cuts and Jobs Act, in an effort to make this an easier process, they said, you know what? If that child has more than $2,200 of unearned income, to the extent their unearned income exceeds $2,200, it's going to be taxed at trust and estate tax rates, which are incredibly progressive and aggressive. They're confiscatory. Higher tax rates at lower levels of unearned income. 37% rate applies to taxable incomes for estates and trusts when they exceed $12,750. You'd only be in a 10% tax bracket on an individual return. Now, look at what happened late last year. It was under the radar gun. The Secure Act retroactively repealed the Tax Cuts and Jobs Act kiddie tax rate change for all children and young adults and reinstated the pre-Tax Cuts and Jobs Act kiddie tax calculation so that it's once again based on the parent's marginal tax rate. Oh, this is crazy. The effective date. While the Secure Act's favorable change to the kiddie tax rates is generally effective for this year, you can retroactively elect the Secure Act change for 2018, amend the return, and or 2019 kiddie tax returns. So who does the kiddie tax impact? The kiddie tax applies to children under the age of 19 or for full-time students under the age of 24. Now you're going to see some similarity here between this and the dependency exemption rules. There's a Form 8814 election. This election means the child is not going to be filing their own tax return. So to make your life easier, and there's a significant cost to do this, if you make the Form 8814 election, meaning your dependent child has less than $11,000 of unearned income solely from interest, dividends, capital gain distributions, or Alaska Permanent Fund dividends as of 2019. So it's 11,000 minus 2,200. 8,800 will be taxed at the parental tax rate. $2,200 of unearned income is shielded from taxation at the parent's rate. Notes: if parents file separate tax returns, the tax rate of the parent with the greater taxable income is used. If the parents are divorced, the custodial parent is the relevant parent. Exceptions from the kiddie tax. Child is married and files a joint return, and for funds being distributed from a qualified disability trust. There's an exception here. With a qualified disability trust, which is a complex trust. It's not a grantor trust. deemed to be earned income. Now, the kiddie tax only applies if the child has at least one parent alive at the end of the taxable year. So how does this work? And I was sharing this with Ross Riskin yesterday at the American College. This is an incredibly funky set of rules. So here's the pure vanilla rule we all hear. Prior to the year a child turns 18, the kiddie tax applies if unearned income exceeds $2,200. Okay, I can live with that. That's what you see in most textbooks. Here's where it gets funky. The year the child turns 18, and only that year, the kiddie tax will apply if the child's earned income is less than or equal to 50% of his or her support and unearned income exceeds $2,200. Okay, so the child has a part-time job, but their parents are still providing more than 50% of his support. And they have unearned income exceeding $2,200. Let's take it a step farther. From the year the child turns 19 up to and including the year the child turns 23, the kiddie tax applies only if the child is a full-time student, the child's earned income is less than or equal to 1/2 of his or her support, and unearned income exceeds $2,200. Now, the feds don't care what that child does with their earned income. So application of the kiddie tax is based on whether the child has earned income, not whether the child is self-supporting. So look at the game plan, right? And a lot of people talk about this CPC, right? Cocktail party chatter. Hey, we want to shift our significantly appreciating assets to our children. So when they sell those assets at long-term capital gains, effectively they pay far less in taxes than mom and dad. The objective, transfer long-term appreciated assets to family members in the lowest tax brackets to effectuate gain and or qualified dividend recognition at a 0% rate. And I'll show you how we can do this. Caveat. This strategy is effective only if the child who sells the property falls outside the expanded grasp of the kiddie tax, and the gain and or qualified dividend doesn't push the child's tax bracket into a marginal tax rate exceeding the long-term capital gain threshold. See, if your taxable income is $40,000 or less in 2020, closer to $40,400 in 2021, there's no long-term capital gains tax. There is no qualifying dividend income tax. So let's think about this. Your son or daughter earns $12,400 a year. They earn $12,400. So if they earn $12,400 and you still provide more than 50% of their support, so they earn $12,400, maybe they're in college, and you're clearly providing more than $12,400 in their support. We don't care what they use that money for. You could transfer appreciated property to them and they could sell it at a long-term capital gain of $40,000 and not pay a dime in federal income tax. Not bad, right? How does it work? Well, you have $12,400 in earnings, $40,000 long-term capital gain. That's $54,400 minus a standard deduction of $12,400. $40,000 taxable income, no tax. Remember, the long-term capital gains and qualifying dividends are not taxed for individuals in these lowest tax brackets. So look at the rates. This is why the trust rules are pretty scary and why the Secure Act was really a blessing. When you look at the tax rates for long-term capital gains and qualifying dividends, far more beneficial using the individual rates than the trust rates. The 20% rate for a trust would kick in if your taxable income exceeds $13,150 in a trust, $441,450 on an individual return. Now, this is something a lot of folks in the special needs community need to be aware of. First party special needs grantor trust. If your child is involved in an automobile accident, let's say there's a personal injury award of $500,000. If your child is totally and permanently disabled, they're going to need to place that $500,000 into a first party or self-settled special needs trust. Now, I know what you're thinking is, well, that's their assets. How could the kiddie tax possibly apply? It does. See, with a first party special needs trust, they are more often than not, they are grantor trust, meaning they are disregarded entities. Here's the million-dollar question. Is unearned income from the child's own assets subject to the kiddie tax? I found this to be fascinating. The kiddie tax was designed to stop parents from shifting income to their children by transferring assets to the child and then having the income earned from the transferred asset taxed at the child's rate. A first-party special needs trust is funded with the child's assets, not the parents. However, the kiddie tax applies to all net unearned income of the child, regardless of the source of the assets that produce such income. Yes, it seems unfair. As a result, unearned income from a first-party special needs trust, grantor trust, that is allocated to a child under the age of 19 is subject to the kiddie tax. This means the tax is computed at the parent's rate and not the child's rate if the income is derived from a grantor trust. If the income is derived from a simple trust or a complex trust, and they both file separate tax returns, perhaps the qualifying disability trust exception could be applied. Because if you do set up that qualified disability trust for a complex trust, and you see that with third-party trust, you can avoid the kiddie tax. Another nuance, what about this 3.8% Medicare tax? And again, we as parents, we always try to do the right thing. If parents elect to include a child's interest, dividends, and capital gains on their Form 1040, the child's income, less the excluded amounts on Form 8814, 2200, is included in the net investment income calculation for the 3.8% unearned income Medicare contributions tax. Wait a minute. So if there's $11,000 of unearned income, and we said $2,200 would be subjected to the child's tax rates, not the parental, that's $8,800. Well, that $8,800 may be subjected to taxes as high as 37% plus another 3.8 because it's part and parcel of the parent's tax return. Alternatively, if the child files their own tax return and they compute their tax based on the parent's effective rate, it appears that the child's modified adjusted gross income determines whether the 3.8% tax is owed, which means it's remote. The standard deduction. You can see where dependency exemption, kiddie tax, the standard deduction are all tied together. If a dependent has income, remember the $12,400, and files a tax return, the dependent's standard deduction is limited to the greater of $1,100. Itemized deductions directly related to producing unearned income or the dependent's earned income plus $350 up to the full standard deduction amount for single filing status. That's why on that example, with the $12,400 for the 18-year-old and a $40,000 long-term capital gain, I used a standard deduction of $12,400. Okay, let's take a look at a couple of quick examples to kind of wet the whistle. John is a 19-year-old full-time college student. During the year, John earned $4,500 in wages from part-time employment and received $2,400 in interest income. John's parents are in the 32% tax bracket and claim John as their dependent. What is John's tax liability for 2020? I know a lot of you are ecstatic about putting pencil to paper right now. So first of all, what is John's taxable income? Okay, John has $4,500 in wages, interest income of $2,400. That's $6,900 minus a standard deduction greater of $1,100 or wages of $4,500 plus $350, $4,850. So John has taxable income of $2,050. But what's his tax bite? Now we have to look at the unearned income. He has $2,400 of unearned income. There's a statutory deduction of $1,100. $1,100 represents the standard deduction, but the bottom line is $200 above $2,200. So here's what they do. The parental tax is that $2,400 minus $2,200, 200 at 32%, but his taxable income was $2,050. $2,050 minus $200, $1,850 at 10%, $185. Total tax to little John, $249. Can we avoid it? Yes, of course we can. What if John's total support were only $8,000 for the year? And his parents do provide more than half of his support and claim him as a dependent. Remember, John is a 19-year-old full-time college student. During the year, John earned $4,500 in wages from part-time employment and received $2,400 in interest income. Okay, look at what happened here. Support is $8,000. John's wages are $4,500, which exceed 50% of his total support. He doesn't have to use his wages for support. Kiddie tax doesn't apply. Though John's taxable income of $2,050 remains the same, the kiddie tax does not apply. His earned income of $4,500 exceeds one half of his support. Tax result, $205. So we save, I know it's not a lot of money, but $44. You can take the family out to Mickey D's or Chick-fil-A. However, ignoring total support, with his parents providing more than half of his support and claiming him as a dependent, can John utilize a $2,050 IRA to eliminate the tax? Remember, John is a 19-year-old full-time college student. During the year, John earned $4,500 in wages from part-time employment and received $2,400 in interest income. Hey, John has no taxable income. The traditional deductible IRA eliminated taxable income. Might that be the best alternative? No. He more than likely is better off with a Roth IRA. Okay. Look at one more example here. If a dependent child is less than age 18 in 2020, all net unearned income in excess of $2,200 is taxed at the parent's marginal or highest tax rate. H and W have one child, Sally, age 16. Sally has $3,600 of interest income and $200 of investment-related fees. H and W have $219,450 of taxable income. What is Sally's tax liability for 2020? Now, if you look at Sally's interest income of $3,600, she clearly has unearned income in excess of $2,200 or $1,400. So $1,400 of that $3,600 is going to be taxed at the parent's marginal tax rate. So bear with me, $1,400. I know this is riveting, but here's how it works. H and W have taxable income of $219,450. with Sally's net unearned income, $220,850. You've got to calculate the tax two ways. One way, including Sally's net unearned income, $41,163, and without Sally's net unearned income, $40,827. The parental tax is $336. That's 24%. So the parents are in the marginal tax bracket of 24%. Sally's total tax liability, parental tax, $336. What was Sally's taxable income? Wouldn't it have been $3,600 minus her standard deduction of $1,100, $2,500, $1,400, party to the parental tax, $1,100 at 10%, $110, $446. Now, no one's going to be asking you to do this, not to qualify for your CE. But you can see that it's far more complex than one would like to believe. Now, in closing, I'll be happy to answer questions. It's a real easy one. I know I said that was the last, but one more. Julie is 12, dependent of her parents. Julie receives $2,400 of qualifying dividends. Julia's parents are in the 37% tax bracket. What is Julia's tax liability for 2020? Qualifying dividends, Julia shouldn't be paying a dime. But if you look at this, $2,400 minus $2,200, she has $200 of net unearned income that's going to be taxed at the parents' marginal tax bracket. Well, they're in the 37% tax bracket, which will mean the long-term capital gain rate, qualifying dividend income rate, is 20%. $40. $40. Julia's taxable income is $1,300, and her net unearned income is $200. Her tax is $40. She's not taxed on a dime because it's only qualifying dividend income, and she's clearly in the lowest tax bracket. The first $1,100 of taxable income is taxed at Julia's rate for dividends, 0, while the balance of her income is taxed at her parents' rate for dividends, 20%. Now, there are ways of avoiding this. Okay, I'm going to take a look at some of these questions if I can. Don, thank you. Don, I'm going to make available a copy of this. I have found a lot of times if I listen to a presentation, I want to review the slides, make the calculations myself. Richard, when you look at support, the IRS has a definition in Publication 501, food, fair market value of housing, education. All of that would be deemed support. And there may be a gift tax, Robert, for parents, but the gift tax is really an annual filing. So if the amount of the gift exceeds $15,000 per donee, you have to file a gift tax return, but that doesn't imply there's any tax due. So I hope that helps you out. And Rita, you should be fine there. Okay, and as Eric has indicated, we will be sharing the slides. I would ask of you one favor for those of you still here. Please, if you're going to use my slides, I don't mind you using them. Use them in working with your clients. Do not place them on eBay to be sold because these are riveting. They will drive up the prices immediately. No, quite honestly, I think they have no resale value. But this is good information to help us because we often get trapped here.